I've ever done. I've done like other stuff where it's like on Zoom. You know what I mean?
Yeah.
Where you chat with people or do like a speaking event or something like that.
Well, that's
But
cool.
sitting here with like full headphones on and a mic in my face, I'm feeling like I'm in the big leagues now.
That's it. We're in the big leagues, baby. Let's go. All right, man. Well, are you ready to get rocking?
Yeah, let's do it. Let's go.
Cool, man. Well, I wanted to welcome Paul Shirrif, commercial banker. For compliancy purposes, we're just going to say he works for one of the big 5 banks, so he doesn't get in trouble. Welcome to the podcast.
Thanks, man. Thanks for having me. It feels great to be here.
Yeah, man. It's been a long time coming. I know we've been chatting a little bit about get you on here, talking about some economic outlooks and all that good stuff. So, yeah, here we are. But let's kind of give the viewers a little bit of kind of a background of who Paul is, kind of where you're from, what brought you to Halifax.
Yeah, absolutely. I mean, I'm originally from Ontario, born and raised in Toronto. Came out here for university and just fell in love with the atmosphere out here. It's wildly different, much friendlier environment. So I ended up sticking around. Started out, doing almost every terrible job on the planet when I first started out of university. I didn't actually have like any educational background in banking or anything like that. I didn't finish with a finance degree. My education was in poli-sci so it's not super super helpful there. But I ended up working at some call center for a bank, and that's sort of my first kickoff. And I've always been a really just very competitive and driven person. So I was like, I'm going to be working at a call center, then I'm going to be the best call center employee I've ever seen. And then, from that I said, okay, fine, you're going to be a shot selling whatever it is, let's call it retail products. Well, then I'm going to sell the crap out of those retail products, right? And eventually I think, success breeds success, and ended up working my way up and then into commercial banking with one bank, and then made a sort of lateral and upward move to another bank that sort of put me in the position I am now in sort of a specialized subsect of commercial banking.
Right on. Yeah, that's awesome. And I mean, I come from very, similar way. I mean, I kind of did a business degree and I got into kind of sales. Like my background was marketing, and yeah, man, like definitely started at the bottom of the totem and kind of worked my way up, did a couple crappy jobs, like you said, kind of, you got to do it. And then landed in consumer goods where kind of worked as a sales rep for Unilever Canada, managing the retail portfolio at the large format stores, and then kind of eventually it evolved into I amassed kind of my old boss's responsibilities and kind of took a hand in some of that large format, but primarily some of the small format business that they had, specifically their ice cream business. So yeah, I think that's something that might be lost in today's world. Like I find like a lot of young folks, and I know even like some folks that that I know, they really want to be here and they're not willing to really put the work in to kind of build that foundation.
I feel like, it's so different than when I came up. Like when we hire these kids in today, their starting salary is like $65,000 a year.
It's 20,000 higher than mine was.
Oh man, that's
maybe
like,
more.
That's like $35,000 more than when I started.
Yeah.
Like I started at like $18 an hour or something like that.
Yeah, I
think
think
$27,000 a year.
Yeah, I started at Xerox trying to sell photocopiers, like inside sales job. I think my salary was like 38,000 or something. Like
Yeah.
I mean, back when we were younger,
That sounded pretty good, right?
Yeah, it was
I remember
pretty
they offered
good.
me $18 an hour. I was thrilled. I was like, hey, man,
Right.
I can pay the rent off this. Like,
giddy
we're
up.
okay.
We still got party money.
Absolutely. I was like, I got this much for rent. I got $150 on the weekend. Let's go.
So, kind of just brushed up against it. Like you're in the commercial banking sphere. Can you kind of tell us a little bit about what you do and maybe give the viewers like a high level overview of commercial banking, maybe what you do and what kind of service you guys provide?
Yeah, absolutely. Especially since my service is more of a specialized subsect within commercial banking. So commercial banking as a whole is, it's sort of lending into enterprise business. So it's as opposed to lending off the personal side. So it's no longer taking into account, say, for example, personal finances at this point. So now you're lending off the credibility of the enterprise and business itself. So, you're talking about the cash flows of that business and sort of measuring them to see whether or not they're credible enough for lending. And that lending size is, anywhere from, say like 1 million up to, it could be like 45, 50, 100 million bucks. And then what I would do within that sphere is I help manage those clients from the treasury side of things. So what it's called is cash management is essentially what it is. But it's helping those clients manage receivables, manage their payables, manage their reconciliation process, and then sort of, based off of that, then help sort of manage surplus cash flow. What are they going to do with all of their liquid, surplus? And from that perspective, what kind of lends into what you do here is that we need to have a good grasp and sort of knowledge of what's going to happen with interest rates, or where are we going with them, what do they look like now, what are we predicting is going to happen in the future, which of course ties into, of course, mortgage rates and all the rest of it. So yeah, that's essentially what I do.
Right on. And speaking of rates, like in the landscape of where we are today, like how do you see this like affecting local business or businesses throughout the country? Like,
oh man, like you're talking about with like our current prime rates at 7.2%, it's getting tight. Like it's getting really tight. Like I think we've so far the Canadian economy's held up really, really well. I think, but if you take a look at sort of some underlying data, I think you're looking at it getting stretched pretty thin at the moment right now. If you're taking a look at sort of like CEBA, what the CEBA loan program was?
Yeah, I wanted to talk to you about that. That's come up for, what is that? That was the Canadian Emergency Business Account.
That's right. It's like an act that allowed them to basically, on an emergency basis, loan businesses money. And then for a certain period of time, it was sort of interest free, and then they'd forgive a portion of it. But the repayment on that hasn't been as good as what they were hoping.
And that was due on the 18th, right?
That's right. So when you're looking at that, that's sort of starting to tell you, listen, these guys are getting stretched thin. And if you actually look at sort of the reports that are coming in, and we can sort of go in, we're going to have to think in a bit, go into sort of CPI and some of the underlying data that's feeding into these sort of inflationary pressures. But if you're looking at what the retailer said, like, last quarter, about 32% of retailers were saying, listen, we're getting stretched thin, like our business isn't, we've seen a material decline in sales. We've seen a material decline in business. And now it's this quarter's reporting about 40%. So you're seeing that number tick up, which is, an indication that consumer spending is going down, which is what we're seeing here in Canada. I mean, if you take a look at the underlying data, consumer spending is going down, right?
And obviously some of the driving factors, inflation,
cost of living,
rent,
absolutely,
groceries, gas prices, and, check me if I'm wrong, but the grocery inflation is kind of totally out of control.
Oh, it's wild, man. Like it's nuts. Like, and it's gotten better, and it's still terrible. Like that's where, if you want to take a look, so we can dive into it if you want. Like, so they just released CPI data last week, and it's sort of been like a mixed bag. So like, the Bank of Canada is trying to get inflation around 2%. Really, their target range is like 1 to 3%, but they like to take the average and call it 2%.
And can you speak to, for the viewers, like, why is it 2%? Is that just like an arbitrary number? Or, because I know, we'd always want to be around that 2% range, because we used to get raises if we meet all our KPIs at Unilever to kind of
keep up with inflation,
which, correct me if I'm wrong, but not all businesses do that. So I was pretty grateful in some sense.
I mean, listen, it's nice if you can be like, right now, I'm not sure there's any business that's keeping up with inflation in terms of raises.
Well, it's too high. Yeah.
It's too high. I'm not sure you're seeing a lot of like 6, 7, 8% raises over COVID. You know what I mean?
Probably never historically.
Yeah, unless you're in a unionized position where they negotiated them in. But outside of that, like in the private industry, you're just not seeing that. But the 2% number is not. It's a target, and the idea behind that target is it's supposed to set a threshold where theoretically, and this is sort of a theory, and it doesn't necessarily always work in practice, but theoretically, what's supposed to happen around that 2% range is unemployment's supposed to be at sort of an optimum level of low, where inflation's also supposed to be around an optimum level of low. So basically, they're trying to say we want the most number of people employed without, at the same time, driving up inflation and devaluing the currency of Canada. So that's sort of the idea of where that 2% or the range of 1 to 3% is where it comes from.
Okay. So, can you dive a little bit into some of the kind of the driving factors that is keeping that around? I think they announced it was around like 3.4%.
Yeah, and 3.4%. So we're talking about year over year, right? So the CPI numbers that came out in November were around 3.1 or 3.2%.
Yeah,
I'm off. I don't have my notes in front of me right now, but what you're seeing is then an uptick to 3.4% here, and it's not bad news. It's not great news. It's sort of like if you take a look at CPI numbers, they constantly sort of go up and down. It's sort of what you would want to be looking for as a trend, right? But one of the things that we're gonna see is, so CPI, maybe I'll start from the beginning here.
Yeah,
CPI
sure.
is the Consumer Price Index, which is essentially a basket of goods that's evaluated by the Bank of Canada. It's like basically they take 8 large subsects of basket of goods. I can't list them all off right now without my notes, but what they're then doing is sort of evaluating year-over-year increases in prices or year-over-year decreases in prices of goods based on that basket of goods, right? And what that's a general indication of is inflation. Like, how much have the price of goods indicated? If a loaf of bread was, say $2 last year, and now it's $2.50, well, we've seen a 25% rate of inflation or something like that, right?
Okay.
So that would be bad. So when we're looking at the CPI numbers, 3.4% is not bad. But when you start looking at the sort of underlying subsects that are within those CPI numbers, it starts getting a little bit dodgy, which I think is why we're going to see some interesting numbers coming out of the Bank of Canada here on Wednesday, or at least interesting sort of announcements, or we'll see what comes. But basically, if you take a look at, for example, some of the really, really important indicators there, like for example, food, grocery, like it's up 4.7% year over year, right, in December.
So that's outpacing inflation.
That's outpacing like target inflation.
Yeah.
Now it's lower than those numbers were the year prior, but that's still exorbitant. Like that's you're paying 5% more from like year over year on a basket of goods of groceries, right? Rent is up like 7.5%. Like it's insane. Like
yeah.
And you think about how much rent went up throughout that COVID period of time. And those are sort of like two indicators that are more important in that basket of goods than others, because they're these are goods that you can't get away from, right?
What would be some of those key goods in this basket that maybe are the most important that they're looking at measuring?
Like these goods, the ones that like the non-discretionary goods. Like you can't say, hey man, I'm not going to feed my family this month, right?
Right.
Or hey, I'm just not going to pay rent. Where are you going to go? You know what I mean? So those are the these would be non-luxury items. And when you're seeing the year-over-year increases and sort of the inflation being higher on those non-luxury items, it's when you get into sort of a large stickier problem. So I think when the Bank of Canada sort of reviews those numbers, what I think they're going to do is probably come along the lines of saying, listen, we're seeing some mixed reports within the CPI data, and even though inflation is on a general trend down, we're not necessarily happy with the way that general trend is going. If that makes any sense.
Right. Yeah, absolutely.
And so I think, originally, like when you take a look at, and what that's really leads into is when are these rate cuts going to come, right? So I'm thinking, I'm sure
great question.
I'm sure most of your viewership, you being a real estate agent, are saying to themselves, listen, man, housing costs are still high. Interest rates are through the roof. How do I afford a home? You know what I mean?
Yeah.
Affordability is at an all-time low for housing, right? I think we've seen it. I saw some data, it was a couple of weeks ago, but I think it was Ontario related data, but like the overall, like in the real estate agency space, like the actual revenue in terms of real estate is down, like it's like a 50% haircut.
Yeah, I'm not 100% on those stats, but I know like for year end last year, we sold like in Nova Scotia, like 4,700 units and change. Mm-hmm. And a few of the agents that I know that have been in the business for 15 plus years said that traditionally we've always sold 5,000 plus units. So, we're quite a bit down, I don't know the exact percentage, but we're down significantly in terms of homes sold.
In terms of actual volume of homes sold.
Yeah,
and then you also have to factor in, like at the end of 2022, there's like a 20% decrease in sort of the overall value of homes here.
Exactly. I think 17 or 20%.
Something like that. But now it's starting to pick back up. Atlantic Canada's done pretty well compared to like the rest of Canada in terms of like homes retaining value. Like if you're in that Ontario horseshoe area, which like dominates the national numbers,
right?
Like it's still down significantly. Oh yeah.
And what do you think's driving that? Is that the mass amount of people that are looking to leave and go elsewhere?
It's just unaffordable. Like, I mean, you take a look at here in Atlantic Canada, you've got people driving to Atlantic Canada or Calgary, for example. Like those are two of those like outlier networks that are actually doing pretty good in terms of like housing price sustainability, because they're still relatively affordable relative to, Vancouver and Toronto, right? And if you actually think, so Vancouver, Toronto would represent sort of 70% of the actual, if you think about real estate as opposed to units sold and like number of houses, but you think of them as like a whole value number, like just a global number, right? 70% of that data comes from Vancouver and Toronto. Yeah. So if you're looking at like how much, percentage decrease in monetary amount was spent on housing, well, 70% of that data is coming from Vancouver and Toronto. So it obviously, sways that data to those sort of massive areas where home values are massive or much more, much more expensive houses. And two, there's many, many more people, right?
So you see some bigger swings there.
Yeah, absolutely. You see bigger swings, and the data, like when you're looking at national data, you're seeing it's not necessarily representative of your local area. So when you're looking at I think when you're looking at Canadian real estate prices, you need to go like city by city or area by area. So maybe in Atlantic Canada, you sort of look at the sort of larger cities in Atlantic Canada. If you're out west, you look at Calgary, which has also been, fairly resistant to house pricing declines. Because again, relative to sort of that golden horseshoe area in Ontario and relative to Vancouver, it's still relatively affordable. You know what I mean? And I think what you're seeing is people moving to those areas from urban centers because they can still afford to purchase a home there.
Yeah, 100%. And like, I know the tune of everything, here locally is like, oh, everything's so expensive. Rates are, money's expensive to borrow. But, in the grand scheme of things, like we're still relatively affordable relative to the rest of the country.
Yeah, I was listening to something else. I think we've gone off on a bit of a diatribe here, but that's okay. Listen, it was about, how much of a decline, like how much of a housing collapse would you need in Toronto to make homes there affordable? And it's even if you had like say like a 90s style recession and a massive overbuild in terms of available real estate, it would take something along those lines to make it affordable.
Really?
Yeah, it's pretty difficult to do at this point.
So there's no going back, is what you're saying.
Well, unless there's listen, there's still in the array of possibilities of things that could happen. A 90s style recession plus overbuild is possible. I mean, if you checked out what they're doing, like the zoning in those areas, like basically every like residential space in Ontario now is zoned for like 3 units now. So like if you have like a home that was built there, you can put a 3 unit on there without having to change zoning or anything.
Yeah, and similarly here in Nova Scotia, Halifax specifically, I think you have to look by geography or area or subdivision, but I think if I read correctly, and I'll have to enlighten myself, but I think you can put up to a 4 unit in the residential area.
Yeah, and I'm like not only that, I think I'm not 100% on the rules here in Halifax, but what's interesting too is like they've got that $50,000 loan too to like renovate your home, to build like I guess an apartment, whether it be for an in-law or whether it be for someone you're going to rent out to, as long as it's on your property. And it's like a $50,000 grant, like just free cash if you build it, which is wild. You know what I mean? Like they're getting creative. Like the cities are certainly getting creative in terms of trying to fix this housing crisis. You know what I mean? That we're in. But
yeah. I mean, they tried all kinds of stuff, like registering all the Airbnbs. That was kind of a
that was, in my opinion, that was kind of a shitty thing to do, to be honest with you.
Well, they should have just said, we want your tax money.
Yeah, or grandfather it in.
Right.
I mean, like you had a bunch of people like that essentially established businesses based off the Airbnb market, and then based off the laws that existed. You could go in there and you could say, listen, we're grandfather this in and say anyone who's created an existing one, here's a registration number. You have to register with the government. We'll allow you to continue to operate. Everybody else, if you're going to operate an Airbnb, you have to have a registration number, and then we're not handing out any more registration numbers, and thus you can't operate on Airbnb anymore. Yeah, which would be I think a more effective way of doing it, or at least a more equitable way of doing it, because essentially what you did is you just put a bunch of people out of business. Right?
Yeah, it's shitty too, because say for example, like we renovated the whole lower level of our house, the garage being the conversion piece that we converted into a nanny suite. That was like, all in, taxes, furnished, ready to go, like, and that's including Airbnb and our lower level. It was like $90,000.
Yeah,
I paid taxes on all that stuff.
Yeah. Yeah,
now you want more?
Yeah.
And I pay property tax for this property, which has went up significantly.
Yeah, absolutely.
So it's like, what are we doing here?
And we have the highest, don't get me started on property tax. We have the highest property taxes out of like almost every municipality.
Why do you think that is?
I think it's because we've got the infrastructure that's set up for large municipalities. We've got, like, for example, water, all that kind of stuff. So when you have that with a population of like 500,000 people, which we're just shy of, you don't quite reach that sort of pinnacle of where it becomes more and more and more affordable. Because, like, for example, like if we get another 200,000 people, we don't have to go build another water treatment plant. You know what I mean? Like the water treatment plant's there. It's in that large reservoir. I forget the name of the lake, but you know what I'm talking about.
Yeah.
You don't need to go build another one of those. You can service the rest of the city or the extra 200 and 300,000 people off the same water treatment facility, right? But so if you're in a city like Toronto, well, you've reached sort of a critical mass or an economy of scale where it becomes a little bit cheaper. But like, for example, like you'd have a $2 million property in Toronto, like heart of Toronto, and they'd be paying less property taxes than I am.
Yeah, which is it's kind of confusing, isn't it?
Like my brother, for example, has got a $2 million place down in Toronto. I think he's paying like, I don't know, $6,000 a year in property taxes.
Wow.
Or $6,500, whereas like my assessed value of my house is like $700 something, and I think it's $780, and my property taxes are like $9,500. It's nuts.
Wow.
Yeah,
that is a big price tag on the property tax. And for some of the investors too that I've heard of, from Ontario looking to invest here, I mean, they're kind of starting to turn away because, that kind of logistically doesn't make the numbers work sometimes when they're looking at property taxes, is the building they're looking to buy vacant? What's the rent rolls? They can barely cover the spread.
Yeah, not to mention like rent control is really causing an issue for outside investors too. Because like, you say, listen, this place could, theoretically, from a revenue perspective, be cash flow positive. Like, okay, well then we're in the middle of a housing crisis. You know what I mean? We can't find enough places to put people.
Right.
These people have a sweetheart of a deal at say $500, in a place that would go for $1,500. How are you going to get them out? Right. And I'm not saying we should eject them.
Right.
But there's no graduated scale to bring rental prices back up to the evaluation of where people are setting those prices. Right. So it doesn't, people are setting those prices as if you could immediately flip the switch, charge market rents, and then make yourself cash flow positive. But you can't. So
and nobody's got the capital to bleed out until people just naturally leave, and you can renovate and put those rents up to where market value is.
yeah, outside of those sort of massive corporations that are invested in that kind of stuff, they don't have it, right?
Yeah, for the small guy, it just doesn't happen.
Yeah, for the me and you, the world, you can't go out there and bleed out $2,000 a month. You know what I mean? It's just gonna be too much.
Yeah.
Anyway, it's interesting. Back to the CPI data, though.
Yeah,
I think that's where we started with this whole thing, and sort of its relation to what I think is going to happen in terms of where we're going with overall prime rate decreases or overnight lending rate decreases, which are tied. I don't know. Would you guys be interested in sort of understanding how the Bank of Canada rate ties into prime rate?
Yeah, absolutely. I think the viewers could do well with knowing how that works.
Yeah, so the Bank of Canada rate is essentially what sets the prime rate, right? So there's a spread between the Bank of Canada rate and what the prime rate is. So, prime rate's right now at 7.2. The Bank of Canada rate is lower, and what the banks do to make money off of it is basically a net. There's a margin between those two rates, and that's what the bank profitability is. So what the overnight lending rate is essentially what the bank can borrow money off of from the Bank of Canada. So banks have to keep a certain allocation of capital on hand for the amount of loans that they have out the door, right? And depending on the buckets of the loans and the buckets of the capital, it sets a different amount. So we don't need to go into that. It's a little bit too much for this. But essentially, they have to have a certain amount of capital on hand to offset their loans. So on a daily basis, they basically evaluate what's on hand. Because what happens is money moves from bank to bank. I pay you, you're with Bank A, and I'm with Bank B. I pay you $1,000. Well, now this bank has $1,000 less in their account. Now it has $1,000 more. It's just a clearing system, right?
Right.
So what happens is they do an evaluation sort of at the beginning of the day or every day on a daily basis. They say, listen, we're in surplus, so we're going to lend money to the Bank of Canada. Oh, we're in a shortfall, we're going to borrow money from the Bank of Canada. And that clearing system sort of moves money between all the banks kind of stuff. And the Bank of Canada rate is essentially the rate at which the banks borrow money from the central bank, which is the Bank of Canada. And then what they're doing is they can borrow money with the central bank and say X rate. They charge X rate on their loans. There's a net interest margin, right? If they say, let's say I'm a big depositor, I've got $38 million in cash, right? Well, I put that in a bank account. They pay me, say, 3%. They're lending it at 7%. Well, there's their net interest margin. But what they're really interested in is what's the difference? Let's say they're paying me 3%, but they're borrowing it from the Bank of Canada at 4.5%. Well, the real net interest margin is 1.5% because they could have borrowed that money from the Bank of Canada, right?
Right.
So that's where the numbers are. That's where the fine tuning of the numbers are. Anyway, what happens is when the Bank of Canada rate goes down, the banks in tandem will lower their prime rate, right? Which is what, all the mortgages are based off of essentially. So, if you've got, that's not entirely true. That's what all the variable rate mortgages are based off of.
Yeah.
The 5-year fixed are more tied to sort of what a 5-year bond price is. But yeah, like that's essentially what's setting it. But the 5-year bond price is then essentially a prediction of where they think the 5-year, like what the 5-year curve is going to be on the prime rate. You know what I mean?
Yeah, and right now we're seeing that the bond rates or the fixed term rates are a bit better than what the variable rate is.
Yeah, for sure. Like you would think so. So the variable rate right now, you've got prime at 7.2. So you might be able to negotiate, say, like variable rate minus 1. You probably know more about it.
Just over 6%. I think the last update I seen from a mortgage guy.
So it's like prime less 1 kind of thing?
Yeah, I think it was like 6.02 or something for variable.
Oh, so like
just over 5% for fixed.
So a little prime plus maybe 20 basis points or something, whatever it is. Prime, so 1.2%.
So what's driving that, do you think?
Well, it's just, so listen, if you're going to pay variable rate, you're going to get a discount off of what prime rate is, but you're locked in at that spread, right? So like, for example, my mortgage, I'm locked in, I think at prime less 1, but I'm paying variable. Not great right now for me because I'm, negatively amortizing my mortgage.
Right.
But down the road could be good.
Right.
So that's what you're paying for. So like, for example, let's say, the banks all came out, they had like a big discussion last week and they sort of forecasted what they think is going to happen for 2024. All the banks were sort of in tandem saying they think that the first rate cut is going to happen sort of mid-year this year, right?
Yeah.
And they're thinking it's probably going to be about a 50 basis point decrease. 20. Some people say 25. Some of the banks say 25.
So half quarter percent for people that don't know what basis point is.
Sorry, 1/4% or 0.5% decrease in sort of the mid. Some people are saying June, could be June, July, and that kind of thing, right? But they're all sort of on the same boat. That think by the end of 2025, you're going to see a 200 basis point or a 2% cut.
End of 2025.
By the end of 2025, they're all
saying, pretty aggressive, isn't it?
Yeah, that's a pretty aggressive cut. So we're now going from 7.2% to 5.2%, and some people are saying it's going to be 2%, some people are going to be 2.5%. Whatever the case is, there's some variability between the banks. Some are a little bit more bullish on the rate decreases than others. It's just the way it works, right?
Do they have any insight on where they think this is going to lead, like the real estate market and potentially like the commercial banking space, where obviously things are a little bit cheaper. We know what happened in 2021 with sub 1% interest rates.
Like I don't think anyone thinks interest rates are going back to like sub 1% or getting down.
Well, they never were, right?
Yeah, I don't think they're planning on interest rates going down to the 0% range again, or like the close to 0% range again.
Well, when we bought this place, I think it was around like 3 something.
Well, I think at one point, like the overnight lending rate was like 0.25%. Like it was like ridiculously low, or 50 basis points at 0.5% or something like that. But it was so low, it was almost 0%. You know what I mean?
Well, keep in mind, I bought this place, or me and my wife bought this place like 10 years ago.
Yeah. So 10 years ago, you're probably talking like normal-ish rates around probably like close to 4% or something like that.
Yeah, I think it was like mid threes, like something like that. Like it was under 4 for sure.
You're talking about for the mortgage rate, right?
For the mortgage rate, yeah.
Sorry,
yeah.
Yeah, and that's sort of typical. So let's say you had your prime rate around say 4.5%. They're giving you prime less 50 basis points on a fixed term. It makes tons
yeah.
of
And this one, I knew nothing about buying houses. I wasn't in real estate. I thought I was gonna be house, so we just locked her in.
Yeah,
like we're just like 5 years fixed. Boom.
But if you locked in right now, it's say like a 5-year. Like I'm not suggesting this. It depends on honestly, it depends on what you can do from a financial standpoint. Like whether or not you have a little bit of
breathing room.
Breathing room in your finances. But locking in right now,
a lot of people don't.
Yeah, I know.
Yeah,
a lot of people
unfortunately.
Did I tell you about that Equifax data there? I'm not sure if we touched on it yet.
No, we didn't touch it yet. But where does that fit into this?
Well, like if you're reading some of the Equifax data that's coming out, so I don't know. Am I allowed to talk about Remax here?
Yeah, why not?
I don't know. I'm not sure. I mean, all right. So there's like a Remax report that came out that basically said that they think that housing prices are going to go up in 2024. Like they think the housing prices are going up because people are going to realize that these interest rates are sort of the new norm, and that paying 4.5%, 5% on sort of mortgages is the new norm, and all of these people that are cash rich from having waited on purchasing homes are going to flood back into the market. And that was sort of the CEO of what Remax said, which I kind of had a chuckle when I read that, and I was like, who are these people that are cash rich? You know what I mean?
Yeah, not a lot.
I don't see it. So all the rest of the underlying numbers that we would see from say Equifax is showing that the consumer debt's going up. You know what I mean? The consumer debt's reaching sort of new plateaus.
So that kind of negates what Buddy said then.
Yeah, like generally, if you have cash, you're not bringing on more debt, right? Like, so those aren't sort of the numbers that we would typically like. If you see consumer, like for example, I think what they're saying, don't quote me on the numbers here because I don't have the data in front of me, but I think they were saying like credit card balances are increasing by 2.5%, while the average payment's around 1.7%. So if you're thinking about your credit card balance going up by 2.5, but you're only paying down 1.7, that means your debt's accumulating higher than what your payment is, right? So you're increasing debt loads while not decreasing debt loads. That's not great. No. You know what I mean? So really what you want to see is those numbers be roughly par with each other, so that you're keeping your sort of debt levels around the same. Or in sort of a contractionary period where you're trying to sort of shed debt, you'd like to see that number go up, right?
Right.
But it's anyway. Long story short, none of the underlying numbers are sort of pointing in that direction. I don't think. I think consumer debt's at a pretty high rate, so people don't have a ton of cash locked in their pockets. So I can understand with a fixed rate, it's probably a more attractive option to most people now, for sure.
So with the Equifax data, where would your outlook be in relation to what Buddy said from Remax versus the Equifax data? Like, where does the bank see things going?
In terms of housing prices, I think you're going to see. It depends on the range of outcomes with what I think is going to be. I think we're leading into a recession here.
Yeah,
like I would think, right? I mean, if you're looking at sort of the underlying numbers here, you've got consumer debt going up, you've got business activity going down, which we all knew was going to happen. Like, listen, when you put interest rates this high, it's going to have a negative impact on the economy, of course. Right? But of course, that's part of the strategy, right? So the part of the strategy is, of course, reduce consumer spending. Well, how do you reduce consumer spending? Well, give them less money,
right?
And then if they have less money, they can't spend goods at all the rest of the local restaurants, the shops, the stores, the whatever it is, the automobile sales, the car, whatever it is. And then when you do that, the economy starts to contract, and that's what you're seeing. And then of course, businesses feel the pressure of that, right? And then wages go down, unemployment goes up, that kind of stuff, and then once unemployment goes up because businesses start contracting, well then now you've got a further problem where there's less money in the economy, right? So and that's all part of the plan. Like that's all what they were planning on doing when they were raising interest rates, right? That's kind of what you need. They need a contraction in the economy. They need a bit of a recession, but the problem is getting it right.
Right.
You know what I mean?
Because we're almost the other side of it now, like where it's kind of negatively impacting.
Well, it's like, okay, so you want ideally what you want. Like if you're the Bank of Canada, ideally what you're looking for is a soft recession, right? You're not going out there and be like, we want like a early 90s recession period. Nobody wants to see that again.
Yeah, and for people like, when you say soft recession, like what does that mean for like the regular people?
Like you want something that you see like a decline in spending. You see, overall, less profitability from businesses, GDP decreases, domestic gross domestic product decreases. You'd love it if international GDP stayed high, but that's probably not the way it's going to work.
Yeah.
But let's say domestic GDP goes down, that's sort of what you're looking for. That's what you'd like to see, right? But, and for a sort of short period of time until you can sort of lower interest rates again and pick the economy back up to get it rolling and then keep inflation at a nice 2% target,
right,
where you've got, say unemployment at sort of peak levels while inflation's not going up, right? That's the ideal. That's where you'd like to go. But of course, measuring that out and putting it into practice is difficult, right?
Yeah.
Like, it's using a blunt instrument to try to fine tune something. You know what I mean?
Yeah, absolutely. And I don't know if this fits into it, but I wanted to ask, I don't know if you have the answer, but like where do you see like fuel prices and this whole like carbon tax playing a factor into?
God, man, fuel prices, like, geez, if I could predict a war in Ukraine, I'd be able to tell you where the fuel prices
right.
Like it's going to be, that's too hard to predict. Honestly, fuel prices, I think, is too difficult to predict for anybody. I mean, you think about like the fact that OPEC can sort of turn on and shut down the taps anytime they want. There's sort of different costs that go into refinement. No, I couldn't begin to come close to predicting fuel prices. But that carbon tax has got to be one of the least popular moves on the planet, right? That's got to be.
Yeah,
it's got to be up there.
I mean, it doesn't take much common sense to realize that the world runs on diesel, gas. The goods get to the stores on boats, trains, trucks.
Well, not only that, but like you think about even like something like home heating. Okay, so like it's the least advantageous people that are relying on fuel oil. You know what I mean? So usually it's a lower income bracket people that use fuel oil or low,
right.
You know what I mean? So now you're putting a tax on the poor for carbon tax, like an additional tax, because everyone's got to like listen. The amount that you can start using your vehicle, sure, it goes down with sort of luxury travel. Like maybe we're not going to do that road trip to PEI, but the vast majority of like how you use your vehicle is necessary. I have to get to my job. I have to go to the grocery store. I can't stop that. So you're just putting a tax on a non-luxury good, right? Not super popular.
No.
And then on top of that, most people who've got say home heating fuel and stuff like that. Well, now you've just are typically in sort of a lesser a tax bracket than those who don't.
Oil was traditionally cheaper.
Yeah, it was traditionally cheaper, right?
Yeah.
And that was sort of a cheaper old school style, and it's usually into older homes, which are traditionally cheaper, and that's how it works. So now you're putting a tax, an additional tax on sort of a lower class group of people, which is again not super popular, and you're doing it at a time where you're purposefully driving up interest rates and then tightening down on sort of monetary supply, so everyone's feeling the crunch, right? Like that's not, I don't know, it's not great. Not
100%. And then the rebuttal on the government's end is like, well, we're doing it for climate change.
Yeah, but then like, okay, which I don't know how political we're allowed to get on this thing, but like it doesn't make sense. Okay, like it just doesn't add up. So if you like Canada's fuel emissions or like CO2 emissions, okay, in comparison to say China, don't even register. Like if we shut down all CO2 emission, it wouldn't change anything on the global scale at all. Like we wouldn't shut down, like global warming would be impacted 0%. 0%.
And then you got India.
Yeah, India, China, like it's absolutely, burning coal for fuel power and stuff like that. It's listen, I understand he wants to be a world leader in terms of climate change, but being a world leader in terms of climate change at the expense of your own people, I think is a stupid move. But that's just my opinion.
Yeah, no, I mean 100%. I couldn't agree more. And it's just kind of confusing that tax is going to solve the world's problems when, like you said, we're a drop in the bucket relative to the bigger continents and countries out there that are definitely producing much more emissions.
I think it's just another, like, I don't know if we're supposed to go into politics here, but like, I don't, like, if you think about, like how out of tune that this liberal government seems to be with the average Canadian, I find it mind-boggling. Like, what was it, the summer they said that housing affordability and housing accessibility is not a federal mandate or federal priority. Like, I was like, what are you? We're in the middle of a housing crisis. This isn't a problem for you guys. Like,
it seems like everybody you call is like, that's not our problem.
Yeah,
even locally.
Anyway, and then like they obviously quickly changed their tune, right? Like I think they saw the polling numbers come out after that and were like, oh man, we really missed the mark on that one.
Yeah.
People are a little bit upset about this. But the fact that you couldn't perceive that or see it means you're really out of touch. You know what I mean? You're not seeing it. Like, it's wild.
Yeah, and I guess, we can keep on the politics thing. Like, a bunch of people I talked to was like, oh, well, maybe we'll see a change once, if we get a change in government. Like, do you think that's going to impact anything, or is it just going to be another guy telling us?
No, I think there'll be some material changes.
Yeah.
I do. I believe that. Yeah. Let's say if there's a change in sort of federal government leadership, I think you'll probably see some changes.
Yeah. And then do you think that might pull us out of this trajectory that we're seeing, like in terms of the recession, or is that like we can't stop that at this point?
I think the recession's going to come regardless, right?
Yeah.
I think it's how it's going to be. Can you limit sort of the damage that happens in that recession? Like, for example, Trudeau on one hand, like, this guy, like, he's got a central bank that's trying to squash inflation, while at the same time he's printing money, you know what I mean, left, right, and center through different government programs. Like, you can't do that. Like, you're fighting your own central bank, you know what I mean? And it's just not a great fiscal and monetary policy, right?
Yeah, and it's confusing to me too to hear people like maybe they're not as well educated on the subject, or they don't really understand how people work, or how government and like economies work, but they're like, we need more programs. We need a livable wage of $20 an hour. It's like, hey guys, one, if you get government money, do you understand that that's your money?
Well,
and
not only is it your money, but it's just reallocating money.
Right. Well, that's my point.
Yeah, it's just a reallocation of funds throughout the system to a point, like, and at a point, like, I'm not saying, listen, everybody deserves an affordable wage. Everyone deserves a reasonable lifestyle. You know what I mean? I don't think people should be out of pocket or living out of their homes. And God knows, you've seen a lot of tent cities down here.
Yeah.
I don't think anybody should have to live in those kinds of conditions.
No, it's terrible.
It's terrible. But at the same time, you can't just bring everybody up to say, $25 an hour and expect, inflation not to increase along with it. And then what you're really doing is just devaluing the dollar continuously as it goes up and up and up. And you're not really making any material or real changes to salary, right?
Yeah.
Like, they're not actually making any more money because the value of the dollar just keeps going down.
Yeah, we're just eroding that value. And some people fail to realize that, like, if Mr. Joe Blow, say, grocery guy has to pay his employees $20 an hour, which I don't know what minimum wage is right now, like 13 something.
That's right. He just charges more for the goods.
Right.
He just increases the prices. Like, I got to make more money to pay for this.
Come on, guys.
like, how do you think it's going to work? Right?
Like he's not eating that.
Right.
In his bottom line, we're paying for it.
Yeah.
So it's like people just have, like, I think people are totally disconnected to how things work too. Like the general
I think they think
population.
Money it's just there. Like, it's cool. It's fine.
Well, Dad used to make the joke when, we were not underprivileged kids. Like, Dad was a lobster fisherman, electrician, worked his ass off. Me and my brother both played rep hockey. And I mean, we might not have had the best gear, but looking back as a 35-year-old man, like, we had.
Yeah, think about how expensive that hockey gear is, man. Like,
oh, man. And, yeah, it's just like some people, I kind of lost my train of thought, but like some people just like, they just don't get it. It's like,
they don't place a value on it, I think.
Yeah, they just don't have like the value of things and how just like things are interconnected. It's just like, you just can't take from here and not have a cause effect kind of over on this end.
Absolutely. I think it's wild. I hope we do see some changes. And also, I hope we don't go into a massive recession. I don't think that's going to be good for anybody. But, it's it is a concern. Like, it's a possible outcome of what's happening here. Like, it's one of the things you'd like to see. Like, one of the things, so we are obviously moving into a contractionary period in the economy, right? Like, that's what's happening. It was done by design. But one of the things you don't love to see going into that is rising consumer debt at the same time. Like, these like two factors going into it at the same time is somewhat worrisome. Like, what you'd like to see is sort of people trying to deleverage themselves a little bit. You know what I mean? Be like, okay, I got to get out of this debt. This debt's really expensive. I don't want to pay for debt anymore debt, so I'm not going to rack up more of it. You know what I mean? Like, the more expensive the debt is, sort of ideally, you're supposed to say, I want less of that. You know what I mean? Not more. But it's not the way the consumer's working, man. It's kind of wild.
Speaking of debt, that leads me kind of into another question. Maybe we could kind of sink in here is, a high percentage, 3.14 million Canadians have mortgage renewals coming up in March of 2025.
That's where I think we get in sort of an interesting period, especially with the Bank of Canada. So, like, we talked about CPI numbers a little bit earlier, right? So we're talking about, hey, like, there's like overall, what happened was we went from like 8% inflation to 3.1, 3.4 down to a 3% range. That's a big sweep, right? So they've done well. Bank of Canada has obviously brought inflation down. Now, of course, getting that last percentage point is going to be really difficult. Like, that's going to probably take longer than it took to bring those massive sweeping changes down. But the underlying numbers aren't all there. There's still some pretty large inflationary numbers on some, non sort of discretionary goods, right? So that's a bit of a problem. But the Bank of Canada, coming back to what you're saying there about 2024, 2025 in terms of home mortgage renewals, is a real problem. because what's going to happen if these interest rates are high or still high to these 2024, 2025 renewals is there's going to be just an off-sell of houses. People won't be able to afford them.
Right.
And the banks are aware of it. Like the banks all know about it. Like they've been pressuring sort of the federal government about it. And they've sort of said, listen, guys, you're going to have to figure something out, which brings in, like, there's only really a few ways you can deal with it. Right. And I think it's going to have to be a combination, which is one is you need to lower interest rates. And I think the Bank of Canada is aware of that. Like, I think listen, we'll know more on Wednesday. The Bank of Canada is going to come out and sort of, tell you what they think. I think obviously everyone knows they're going to hold the rate steady. Like the overnight lending rate's going to stay steady. I think, on
at
Wednesday.
least steady. Yeah,
at least steady on Wednesday. But I think they're going to sort of say what they think of sort of their economic outlook for future and when future interest rate decreases may come. So that'll be interesting to hear. But I think what you're gonna see is that they're somewhat hamstrung. Like they're stuck a little bit because they got to get those numbers down by sort of March 2024. To sweeping through all the way to 2025, right? Like it's going to become a problem because if they don't, you're going to have like a housing crisis, like a housing market bubble collapse.
Yeah, do you think that's what we're in for if that happens?
Maybe not a full market collapse like the way you'd see it, because there's some pressures here within Canada, like our immigration pressures from Trudeau. Like for example, like the number of immigrants we're bringing in at like sort of 500,000 a year to sort of 700,000 new immigrants a year is a crazy number. It's a high like a massive number,
Yeah.
and they all need somewhere to live. So you've got like a little bit of a bottom at the market of that floor, I think. Anyway.
Yeah, and I think what I read, and don't hold me to these stats. They might be outdated now. They might be a little different, but I think the stat was for every 7 people that are coming in, we're only building like one house.
Yeah.
And so CMHC article just said that we're like 20,000 units behind to start with.
Yeah. Like and the problem is too, like the other issue is the cost of materials, right? So you build a new home, but it still costs X to produce that home. So you can't sell it for less.
Right.
So like there's some floors in the market that sort of set it there, but I think like you've seen a correction in the housing market, right? Like in Ontario, for example, more specifically, you've seen much more of a housing market correction there than you have here.
Yeah, I think we're down like 17% here.
Yeah, and I think it's actually picked back up a little bit from that number 17%. I think it was 17% at the beginning of the year, but I think local data it's a little bit higher now.
Is it local? Yeah,
well, I think we saw
my number might be a little updated.
I think we saw a turnaround in the spring, didn't we? I don't know. But
this past spring?
Yeah.
I'd have to check on that, but I know something I just seen was like it said we're down right around 17%. What kind of when we did our kind of year end or year start kickoff at Remax, it kind of went through some of that.
Yeah,
yeah.
Anyway, the long story short, yeah. So if we've seen a decline in prices here, that's fine. You've certainly seen it in Ontario in the larger markets. But I mean, like, there's sort of a line from like the Ben Tal, he's like the chief economist for CIBC. And he said, in COVID, like we saw a 45% increase in housing prices over breakfast. Like
right.
It was such a short period of time to see a 45% increase in housing prices.
And that's never happened.
He's like, a 17, 20, 25% reduction in housing prices, it's probably good for us. Like, It's probably not the end of the world. Like, we probably need this. But what we don't need is like further pressures to bring it down after that. Like, you don't want a full collapse. What you don't want is people saying, I can't afford my home anymore, selling off, and there just being just a ton of supply and then no demand because nobody can buy it because, the interest rates are still too high.
And I guess that's some of the competing factors too, is like, one, inventory is still super low. Mm-hmm. And then immigration and people coming into Canada, or people like say coming from elsewhere in Canada that wants to be in Nova Scotia, like that's still a driving factor as well. So like,
for sure.
Is that going to stem down some of that?
Well, I think they're starting to, I saw an announcement today that Trudeau put out that they're going to start limiting student visas, for example.
I did see that. I read that. Yeah.
Yeah. I read that in the Globe and Mail this morning, but like, so I think they're aware that there's some issues. Like, I don't think they plan on stemming down immigration, but I think they're trying to stem down overall requirements on housing. You know what I mean?
So do you think is like the underlying objective here for all this like mass immigration? Like,
well, I mean, listen,
especially considering like we're bringing them into places that, like specifically to here, like we don't have enough doctors, we don't have enough psychiatrists, we don't have enough services, like we don't have enough apartments for them, we don't have enough housing. Like, what are they getting out of getting here? Well, like, what's the dream we're selling?
I've spoken to a few immigrants myself, and this is all anecdotal, so don't quote me on this section of it, but like, or don't quote me as like a stat. But anecdotally, like what I've heard is that internationally, they're sort of sold on this idea that Canada needs immigrants. Like they need you there, like they need you badly. Please come, like we'll do whatever we can. And then once they get here, they're like, holy smokes, it's cold. There's no homes available. Like, right. I can't go anywhere. Like, this is not the dream you sold me on. And the truth is, like, we need immigration. Canada is only going to be sustained on immigration. It's certainly a requirement. We're not building up a large enough workforce. We're not, creating enough babies or children ourselves.
Yeah, we're not.
To propagate enough. So we require immigration. That's just a fact of life. it's just creating sustainable immigration, like immigration with setting the parameters for the right types of people, right? And what I mean by that sounded like it could go in a way, there's a variety of ways that I don't mean. So please don't misinterpret that. But it's the right trades. Like, for example, we need to, at this moment, like we're heavily short on skilled tradesmen. You know what I mean? So we've got a housing crisis, and we need to bring these people in, and we need to house them. We don't have anyone to build the houses. So, what we need is skilled tradesmen, but that's not necessarily, where our mind has been at previously in terms of immigration. And so those points aren't scored as highly as others. So there needs to be some adjustment work done there, I think, so that we can, build the infrastructure required to sustain immigration.
And do you think we're kind of lagging behind in our forecasting and planning for like something potentially like this to happen? Like, it feels like we're way far behind the 8 ball, where people maybe just like knew some of these things were an issue, but like we just kind of kept with the status quo, and now we're kind of caught with our pants down here.
Yeah, it absolutely feels like that, doesn't it? Like, I mean, you take a look around, you're like, listen, we set record targets for immigration, and we just sort of thought, hey, the free market's going to keep up without making any plans for it in advance, right? And so that's obviously been a problem. And I wonder if it's not going to be, like, I feel that what you might see is an overcorrection. You know what I mean? And that's where, like, if you talk about the range of outcomes and what's going to come in the sort of housing market, I think there is a range of outcomes where it does take a pretty big dip in the short term. You know what I mean? Because what you're seeing now is cities just scrambling to fix the problem. You know what I mean?
Scrambling.
Yeah,
they don't even know what to do. They're just drawing straws almost.
Yeah, like, I mean, they're rezoning at a rate as fast as they can. You got the federal government, they put out this, like, what do they call it? They call it like the Wartime Housing Act or something like that.
Yeah.
It sounds good. Like, it sounds really good, right?
Yeah.
Like, it sounds awesome.
On paper. Sounds good,
but it's like, what is it? It's like they're going to, sort of establish these plans. It's only going to be by the end of this year, too.
Communism sounds good on paper, too.
Doesn't always effectively work.
Right.
It's like, we're going to have these, like, pre-built plans that you can just cookie cutter put them out. Well, the truth is most builders are doing that anyway. There's only like 6 plans that like big, heavy commercial builders are using anyway. Like, it's all kind of,
it's like smoke and mirrors, man. You think like, Joe, all the builders are just like, yeah, build whatever you want. It's like, no, here's the 3 or 4 house styles I have.
Yeah, like, these guys are all trying to make money, right?
Yeah.
They're not like, you know what, I'm going to build an architectural wonder here that's going to look so vastly different from everything else. It's going to just inspire the mind. That's not what these
They'll do it for you, but you're paying.
You're paying, yeah. If you want to do that, that's going to be a specialty project, right? These guys are in it for the buck, right? They're trying to make money.
Yeah, like right now they're trying to move, like, they're trying to push like modular homes, like people that are building homes in warehouses that are easily put up quicker and kind of, in more controlled environments that arguably make for a better quality home. Also, like, I was kind of digging into some stuff, like, you remember the Sears catalog?
Yeah.
Well, in terms of modular homes, and I was going to do a reel on this, down the road or here shortly. Sears used to have like a catalog. You can pick the homes. There's some Sears homes here in Halifax.
Yeah, like, doesn't Kent have that too? Like, they've got those like sort of like modular, like,
prestige homes.
You can like go down there, you pick it, like, I want this one, and it's it's like it goes on a blocks. Like, it's not built, like, it goes on. I don't think it's like built with a foundation. Like, it's just put on sort of like an existing foundation or whatever. But,
yeah, I mean, I think there's a multitude of different options. I think the slab or whatever you want to do. I think it's I think you can pretty well do anything if you want to pay for it. But, I mean, you got like Prestige Homes, you got Supreme Home Builders, which one of the guys at Remax is a retailer for. And I have a client that might be looking at, getting a modular home because everybody's got quotes from in terms of the rest of the kind of small local builders or bigger builders. They're quoting him way over what his budget is. So when people are looking at affordability and what they can afford, like, sometimes these modular homes fit. And people have this, like, misconnotation that it's like a lesser thing, but I mean, you look up some of these websites, Supreme Homes, Citadel Homes, Prestige Homes, like, it's not a trailer. It's a well put together home. It's just, done in a warehouse.
Yeah, and there's listen, you have to get creative when housing affordability is out of the grasp of the average human being. Like, you've got to get creative. You know what I mean? People have got to have a place to live, right?
Yeah, and like the last time I looked into it, when I was producing some content, like the average 2,000 square foot home, if you want to build less land's like 700,000.
Yeah, it's insane.
And like, that's not like, all the fancy bells and whistles. That's like pretty basic. Like, here's your home. 2,000 square feet's a pretty big home, but you're $700K, 150, 250K for the land. Like, you're almost $1 million.
Yeah, I think what you need is like a slow correction over time, which is what you fingers crossed, you hope happens. So, like, it's not going to be fixed overnight because the building costs that go into it are super expensive. Like, if you're to build a 2,000 square foot home, it's, you said it. What did you say the cost were? Around $7?
Yeah, on average, I think it's around 7. I
700.
mean, it could have, again, like, don't quote me, but like when I looked it up at the time, that's the
Like
that
roughly
was the rough
$700,000.
average. Yeah.
So like you've got a base cost there set at 700.
And based on my client and what he's trying to build, which is around like, on a slab, bungalow style, like just under 1,500 square feet, and everybody's quoting him almost 600K.
Yeah.
So put another 500 square feet on that.
Like that's wild, man. That's such for like a prefabbed house that comes out. Like that should be.
Yeah.
It's wild. But I mean, listen, it is. So you've got to start looking at alternatives, right? And like the other problem, and like it happens a little bit here, but it's happening all over the United States, which is a big concern. Like these massive conglomerates like BlackRock are coming in and sweeping up residential homes. Like I don't know if that's starting to become a concern.
And they're worried about the small time Airbnb guys buying up homes. You know, it's like maybe that's where you got to start looking, and that might produce a bigger impact in terms of affordability. But
like you want to talk about something that's of a large concern, I'd be keeping my eye on that. There's already been articles written about it, and I think at some point they're going to step in and they're going to have to do something, because like the American dream is built off of the concept of getting a job, owning your own home. You know what I mean? And
that is also, I think, fair to say, the Canadian dream.
Yeah, absolutely. It's the Canadian dream, American dream are very similar, right? But like these massive corporations coming in with just market capitalizations that blow the mind. Like I look it up. I can't remember what BlackRock's market cap is, but if you take a look at their market cap, it's insane. Anyway, so like just coming in and buying up residential houses to rent out. Like that's like the last thing you need or last thing you want is an environment where home ownership is now a luxury. It's not sort of an established thing that you can have if you work hard and put your head down. Like and I think that's a potential outcome as well. Like if BlackRock is sort of, sorry, I keep blaming BlackRock. It's not just them. There's all kinds of corporations doing this. Don't sue me. But like if these massive corporations come in and keep buying up residential homes, like it's going to become impossible to be a homeowner in the future. Like it'll be essentially a luxury that not everyone gets as well.
Which is sad, eh?
Yeah, and I don't think there's any way we'll allow that to happen. Like I don't think the United States government will let it happen. I don't think I think the American dream is so entrenched both here and in Canada. Canadian dream, American dream is so entrenched into our value system that I think eventually we'll put an end to it and say you can't do that. But it's happening now on a large scale.
Yeah, would you say, like, I know, like, there's been some chatter, in the last, 6 months to a year. You hear it around the brokerage. I know some of the guys that, I work with in the brokerage have had a few meetings with some REITs. And it seems like we're kind of a big target as well for REITs and investments. And
yeah, for sure. Like those are, and we're going to have to see what happens there too. Because some of those guys, like those REITs, like they've got some, like the borrowing costs are hitting them as well, right? So like I think for a long time we were targets. Like I know, for example, when I sold my home, a REIT put in a purchase order, like they put in a submission right on my house. When I was
in Sunset?
In Sunset Ridge.
Oh yeah,
yeah, they did. A REIT put in like an offer. We didn't end up selling to them. They didn't have the best offer, but like they put in an offer on it. So
of course they wouldn't have the best offer.
No, of course they didn't. They tried to lowball it,
Right.
but like. But yeah, like they're in there. They're like, hey, listen, we can rent this place out for $2,500 probably a month or whatever.
How often do you think you see that happen? Because like I haven't had anybody on my listings or seen any competitive in terms of REITs.
Yeah, but you got to think about that listing. Like that listing over in Sunset Ridge, it's like a duplex that's 2,000 square feet. It's relatively new. Like
you're renting it like that.
You're renting it like that. It's three bedrooms. It's in a decent neighborhood. It's in Sackville, so it's a little bit far out, but it's like a relatively new build, and it looked kind of fresh and clean. Like that's one of those ones you could probably rent out pretty quickly to a family for $2,800 a month, right?
Yeah, and I know and I mean we were talking, like I know we've kind of been back and forth. I mean you're a buddy of mine, and we've been talking about investments and different things, and like we just kind of were chatting about it the other week, and we were like, oh, what can we rent this place for? And I was like, well, this guy over here I know at the brokerage has a semi that he's trying to rent for $3,100, and that was like a 4-bed 2-bath. Yeah, but duplex, like similarly, like half a house, like, and it's just getting insane.
And it's on one hand you're like, geez, man, like this is awful. Like how do people afford this stuff? You know what I mean? Like if you're trying to, if you're, even say like a median income earner, like how do you afford a place for your family if you're spending $3,000 a month for a 3-bedroom house? You know what I mean? Like
I bought this place 10 years ago, and me and my wife weren't doing as good as we're doing now. And the bank approved us for like $450. We bought this place at like $212, and I thought I was gonna be house poor then.
Yeah, dude.
And that was like $1,200
So the rule,
$1,200.
So what they established the stress test on real estate is what, like, so it's either 5.25% or 2% more than what you're currently paying, right? That's the stress test rule, right?
Yeah.
And I think they've maintained that stress test rule. But like prior to like during COVID times and prior to like the interest rate increase, now I haven't checked out. This is like retail knowledge from a long time ago. Essentially, it was like 4 times your salary. Like that's what you'd approve.
Yeah, that's the rough multiplier. I think they still use it today, but with interest, it's kind of,
yeah, maybe a little bit lower.
A little bit lower, yeah.
Yeah, like 4 times your salary. So, if you're making, like, let's say you've got a household income of say, like, let's call it $150,000 a year. Well, you've got a $600,000 house approval, right?
But they don't, a lot of people, and I see it all the time now, like, we did the math when we were buying. I was like, the bank wants to give us $450,000. I was like, man, if I buy a $450,000 house, the only place you'll find me is in that house.
Yeah, because I can't leave.
Right.
I'll be eating rice and beans, man.
Yeah, if that. It's the Jip Rock.
Yeah.
And it's like now people are maxing that out just to get in a home. And it's a shame.
And that's we sort of touched on earlier where you got to see people start to deleverage. Like that's what happened. In other sort of recessionary periods, like people start to deleverage themselves. Like, listen, man, I can't afford this home anymore, so I'm going to start, removing myself from sort of these debt obligations.
Yeah,
right?
Or like maybe you don't get the fancy car, maybe you get a regular car, because for every $800 to $1,000.
Or maybe you keep the car, and you are starting to see that. Like, so what's happening is auto sales have gone down. Like, if you look at the CPI numbers, like auto sales have taken a big hit in terms of sort of increase in auto sales and stuff like that. So that's good news. Like that's some of the good data that comes out of that. The other good news that's coming out of CPA data, services have remained flat. You know what I mean? Which means that people aren't increasing the prices on services. They're sort of staying stagnant where they were, and that's good.
People
news.
won't pay them at a certain point. There's a diminishing return, right?
That's it. Now we just need to get Galen Weston to get on board and stop increasing prices at the superstore. And so,
right?
Yeah.
Yeah, and
I don't think that's going to happen by then.
And friggin' guys, do you see the? I got shit for this from another guy that owns a Canadian Tire. He wasn't happy, but I see it in consumer goods through my whole career, and anything they can do to shrink bags and the quantity and put the price up, and they'll make this sob story that it was like, oh well, we got to pay more for our fair trade goods or this and that, or whatever the excuse is. And then grocers. Through COVID, we were funneling people in like farm animals to Sobeys, Superstore, Walmart.
Did you see what Galen Weston said the other day? So they've been some so the federal government has sort of put some restrictions on these large grocery stores, all grocery stores essentially, but more heavily impacted on sort of the Sobeys and the Loblaws of the world. Loblaws owned by Galen Weston, which owns Superstore and the rest of that kind of stuff. But anyway, so
I know that they don't.
Yeah, well, they do now. So
it's my old world.
That's your old world, yeah. So Galen Weston came out. So the federal government's put restrictions like, okay, you can't increase prices on like sort of necessity goods like bread and all the rest of the eggs and a bunch of stuff. Like we're putting like a freeze on increases. But so he then came out this week, or was it last week? Sorry. And he said, listen, those 50% decreases on expired, like
that's what I was getting to.
Yeah, that's soon to be expired meat. We're getting rid of it. We're not doing that anymore.
Fuck you.
Absolutely.
You fucker.
He's like, you think you're gonna mess around with me? That's it. No more price decreases for anybody. No more breaks. That's
right?
It.
We're just gonna sell you rotten food at full price.
Full price, and we'll fucking throw it out if we don't want it.
Right? Teach you. Yeah. I couldn't believe that, and that's what I put. Like basically, the sum of my little story was like, it's all greed.
It's gross,
and like they'd rather just, give somebody a break for, and it's a lot of times stuff that's going expired.
Yeah.
So it's like, maybe somebody that's in a less well place is scooping all that up and they're making it work.
Well, so it's for the people like, listen, there's nothing wrong with the meat. It's a best before date, right? So like, best before dates are somewhat, listen,
it's a
suggestion, right? Like you're probably
still smells good. You can still cook
eat it. But like also if the best before date's tomorrow, it's still good meat. It's just, listen, I won't be able to keep it in my fridge for, 3 days.
Yeah.
Right?
And then like the health and safety guidelines for them doesn't allow them to sell it anymore.
Right, exactly. So they've got to get rid of it. So you mark down that particular good, you move it off the store floor, right? And then somebody who's like, I'm going to cook this tonight. Great, I just saved myself 50%. Perfect.
Yeah, and it's very apparent, like Buddy at Loblaws, like I was saying, like, everybody, we're only allowed to shop at Sobeys, Superstores, Walmart, shop, the major big grocers. And I mean, I'm not going to believe anything less if this guy calls me and tells me otherwise, but like, the way it works in consumer goods is if you have, and this isn't just in COVID. This was like when I was in Unilever, if you had a big promotion that garnished X amount of dollars and it was a huge growth over last year at that month, they want that number plus more the next time.
Yeah, dude. Absolutely.
Or you're paying penalties or they're taking it from you another way.
That's absolutely like it.
And now they never got that revenue that they got in 2021. Where can we get it?
Yeah.
Well, screw your 50% offs.
It's just like, listen, okay, you want to play ball over here, then like if you want to play games, we're gonna do the same thing. We'll find other ways. Like, what are you gonna do? Make us sell discounted meat? Can't do that. So,
Right.
you know, it's who
It's
pays?
a shame for the greed that's going on too.
Well, who pays? The Canadian consumer pays. You know
Every
what I mean?
time.
Every time.
Every
and
time.
And these, you know, you got Loblaws and Sobeys making record profits quarter over quarter, and they're just like, listen, we're gonna bring more in. Come on, baby. You're
Yeah.
like, can you just calm down? Can you just relax? Help the Canadian consumer out for just a minute.
I know. And my buddy, my old boss, Rick Monroe, he's like, I remember he's like, you can tell when a grocer's doing good. I was like, no, I don't. Like, why don't you tell me? He's like, when they start paving the parking lots, that's when they've done well. And like that Superstore, I think they paved that sucker over.
That's great,
man. Renovations.
Oh man, yeah. You know what's funny?
They're hurting though.
Have you ever checked those small grocery stores out? I was driving by one. This is anecdotal again, but I was driving by one with Chelsea the other day. That's my spouse, for everyone who doesn't know. And then we we drive by this like little tiny groceries place, and it's got like those old school shelves.
Yeah,
like, you know what I
man.
mean? Like
Yeah.
look like beat down and stuff.
Yeah,
like
yeah,
that.
yeah.
And I was like, you wouldn't see that at any of those anymore. Like that's just not happening. Like that's what they've got. They've got a model where it looks sophisticated, nice. You come in, it looks cleaner, it looks fresh.
They're all
Everything looks
updated.
good, all updated, modern, and that's where people want to go in. They bring them in. Nobody wants to go to that old grocery store anymore with the beaten up parking lot and the
Yeah,
you know,
the one in Liverpool, the Sobeys in Liverpool, if you've ever been in Liverpool. That's probably the only original looking Sobeys from when I was young.
yeah.
And I don't know why they never updated it, if it's just like Liverpool's too small, or no offense to anybody from Liverpool. But they got the OG Sobeys look, like inside and out.
I'd go there, man. I'd be into it.
Yeah, well, I mean, sure as everybody else is. But yeah, and the one thing for me in terms of like that caught me, like, do you ever eat those Dagwood sandwiches?
No, I've never had a Dagwood. What's that?
Okay, so next time you go to Sobeys, if that's where you shop, if not, then screw it. But used to be this like big friggin' honking sandwich. They'd have it on a styro. It was about the size of that book. And it was just like deli meats, and I think they just like had leftover whatever from making
It's like
sandwiches.
a Subway sandwich, which is massive.
It was huge. You could get that when probably we were in university for like $3.99. And I mean, I'd have like, let's be real, back then I'd eat the whole thing.
Yeah, for
but
sure.
if you're a regular person, you could split that sucker up in thirds and probably have a lunch every day.
For sure. Like, no, it's ridiculous. I looked at a price, like, so I have to buy cereal. I've got kids, right?
Yeah,
so I, mean,
yeah.
I don't eat a lot of cereal, but the kids eat a lot of cereal. I go in there, I look at the price of cereal, and it blows my mind. I'm like, what are you talking about? $8.99 for a box of cereal?
Used
like
to be
that.
$4.99.
Yeah, dude, it used to be $2.99, $3.99. Like, what? You
Yeah.
tell me to buy a box of Rice Krispies costs $8.99?
Well, this sandwich used to be $3.99.
Yeah.
I was doing showings out in Hammond's Plains. I was like, free it. I'll stop at the Sobeys in Tantown. I'll get one of these sandwiches. I hadn't had one for a while. Now, half the sandwich, and I mean, that's being generous. I think it's almost like a third of it. $8.99.
$8.99. That's wild.
Get out of here, Sobeys.
That's insane. That's such a massive increase. You know, see, that's
That's
where I
not
don't-
even on par with like the inflation we're seeing. That's
No,
like
it's way over.
Way over.
Way over. And like there's some goods that'll be, you know, sort of more on par and keep it at sort of a normalized rate. But on those goods, like I feel like it's the same thing with cereal and stuff like that. The thing is, I don't see a way out of it. Like, how do you stop it really? Like, that's the problem.
I don't know.
Because you're dependent on groceries, and they don't have a monopoly, but they've got a pseudo monopoly. In fact, and there's been incidents that have proven where they've basically done price fixing between Sobeys and Loblaws, which is awful. They've been, you know, they've had to like go repay. I think if you go back and you say you bought bread from like
Yeah,
a certain
Wonder
period-
Bread.
yeah, Wonder Bread, they'll give you like $1.30. Anyway,
Yeah, and they're just like, they just got a little slap on the wrist. Like,
yeah,
don't do that again.
Don't do that again. Anyway, but like I don't know how you stop it. Like at least with the rental stuff. So you look at that CPI data. You're saying like, okay, 7.5%, you know, increase in rent prices from last year. Okay, well at least you see people are actively trying to fix that. They're like, okay, so we're going to rezone most municipalities so that you can build triplexes
Yeah.
on what used to be single family homes. Okay, well like then that's automatic. Like that's just if you own a single family home, that place can now be a triplex. So now we've got development happening. You know what I mean? And the number of people, like it's much more affordable per square foot. Like if you're trying to build, like let's say like, you're trying to build like a high rise rental apartment, it's probably $600 a square foot or something like that to build, right? But if you're trying to convert your house to a basement apartment, probably closer to like $100 a square foot.
Yeah.
So now you've got a much more cost reasonable approach to solve a housing crisis, right? You're like, okay, so we'll maybe stem, like you can already see them turning off the taps. Like, all right, we're going to slow down student visas, so we're going to have fewer people coming in that require housing. We're going to keep immigration flat, which is what Trudeau said he's going to do. And then what we're going to do is we're going to, you know, turn on the taps in terms of you know, building up more housing, right? And I mean, you can see it all over the city here. You can
Oh,
see
they're
there's-
giving her, but we're so behind.
We're way behind, right?
Yeah.
But at least you can see an end in sight. You're like, okay, I get it. Like there's a way out of this, right? But I don't know how you control these grocery chains.
Me neither, man.
I don't know what you do with that.
Me neither. But you know what? I think this might be a great place to end it. We had a
Sounds
little
good.
recap there. Question mark, grocery and food. Who knows? We'll have to stay tuned to see what happens there. But no, I really appreciate you coming on. I appreciate you kind of giving us and the viewers a kind of high-level understanding of the kind of economic outlook for Canada, Halifax, and the real estate market and businesses and so on. And yeah, it'll be interesting to see how things play out. And I'd love to have you on again when we got some more data maybe we could talk about.
Yeah, man. I mean, listen, the numbers are always changing all the time, so I'm happy to come back anytime. And I appreciate you having me, man. It's awesome.
Awesome. Thanks so much, Paul. You have a
Cheers.
good one.